Today I'm going to be talking about how to implement fundamentals into your Forex trading strategy, the importance behind fundamentals and exactly which ones we should be looking for and how they move the market. Fundamentals are really important to utilize within trading because they ultimately are steering the direction of the currency pair that you're looking at, both for the short term, mid-term and long term. And around these events and economic key data points, these are areas of interest and they're also going to be turning points within the market. Fundamentals are very different to technical analysis. They specifically focus on chart patterns, support and resistance zone levels, moving averages, that sort of thing. Fundamentals focus on a completely different aspect of the market. These are focusing around economic key data points such as interest rate decisions, NFP data, CPI, RPI. The significance behind fundamental analysis is really important. It should be the backbone to your trading strategy, which ultimately is driving the decision that you make to whether buy or sell or sit on the sidelines. What you're doing is you're gauging the country's economic health to make trading decisions of whether or not you think that their currency is going to appreciate or depreciate. So in order to do that, we need to look at detailed components behind an economy and what actually is moving behind those cogs. And this ultimately is what we're going to be discussing is key economic indicators and how these affect a currency and how you can make decisions based on your trading strategy with the overall fundamental analysis. So key economic indicators are pretty much like the vital life signs behind an economy. The first one that we want to look at is GDP, Gross Domestic Product. GDP represents the total market value for all goods and services produced within an economy. The second one that we want to look at is inflation rate. Inflation rate is an important economic indicator to take into account. And specifically to look at inflation, we can do this through Consumer Price Index. And CPI reflects the purchasing power and the cost of living. And finally, we want to look at employment data. We specifically do this through NFP, known as non-farm payrolls. It allows us to see the health of the labor market, how that's doing, whether it's contracting or expanding, and overall gives us an outlook into the consumer spending potential. One of the main areas that I really like looking at is interest rates. Interest rates is a big factor within an economy, especially when you're comparing two interest rates of a currency against each other. For example, pound against the Japanese yen. Pound has high interest rates, Japanese yen has negative interest rates. So how does that compare and what will that do to a currency is an interesting point to look at. So interest rates don't only control the cost of borrowing, but also how much foreign investment is attracted to that currency based on the interest rate. With this overall, it helps us to understand what is the currency demand based off of the interest rate. Also from an outlook of political stability behind that currency as well. Obviously with a foreign investor, if they were to put their money, for example, in the pound, they're going to be earning positive interest on their money. If they was to put it with the Japanese economy and their negative interest rates, they would be losing money on that. So the attractiveness of foreign investment to the pound far outweighs the Japanese yen. And therefore you would see a positive sentiment through the currency pair of pound against the Japanese yen based on the differentials between the interest rates. This also changes obviously based on political stability throughout that and also the outlook and attractiveness of a currency. And then following on from this, most importantly, you've got the impact of news events. News events such as policy changes and political announcements, elections. These are all things that can affect the sentiment of a currency and the currency's value. A good example of this would be when Liz Truss was Prime Minister within the UK and she tried to take her political power and influence the economy in a sense that not many people agreed with. And you can see exactly what happened with Liz Truss and the pound value during her time, a very short time as Prime Minister. And that is exactly one of the key points of understanding around fundamentals, that if you can understand the geopolitical tensions and all of the fundamental key factors around an economy's health, these will all give you insights into how to predict the future for a fundamental outlook for a currency, and specifically a currency pair. and then after that, implement your technical analysis. So why do fundamentals even matter? Fundamentals matter from the perspective of they change investors' sentiment within a currency. So the perfect example of this would be looking at the pound, which currently has an interest rate of 5.25%. And then we've got the Japanese yen, which actually has an interest rate of minus 0.1%. So if you was an investor, where would you park your money? Would you put it in the pound or the Japanese yen? It goes without saying, you'd put it where you're going to get 5.25% interest rate instead of minus 0.1. Now, if we're looking at that pair pound against the Japanese yen, let's just say that all of a sudden the Bank of England decides to raise the interest rate by 1%. That was an unexpected move. So therefore, that's changed investor sentiment because it wasn't panning out how they planned. And actually that would create what we call a surge in demand in that currency. Now, you would also see that demand change against other cross pairs like pound against the US dollar, for example. However, because the Japanese yen's interest rate is negative, you're going to see the move happen a lot more on that currency pair because the shift is a lot more extreme. So therefore, you would see pound value increase and you'd see the pound against the Japanese chart just absolutely skyrocket whilst that fundamental announcement has happened. And again, likewise, that could also be a negative outlook for the perspective of, let's say that the Bank of England at this moment in time in 2024 is set to decrease their rates over 2024 at a slow pacing, I think 3.25 percentage points. So if that was to change and all of a sudden they was to do a huge decrease in the interest rate, let's say a 1% to the downside, you would then also see the pound drop in value because it's a big shift in investor sentiment and their understandings. That can also lead to an onset of panic, and fundamentally we'll see pound drop in value based off of these changes. So in the perfect world, rather than what we seem to see on YouTube is just technical traders, you should be looking at the markets from a fundamental approach, using these economic indicators that we've discussed to give you your broader direction of where a currency is moving based off of fundamental expectations, interest rate changes, CPI figures, GDP, and also employability in the labor market behind an economy. Once you've sort of crunched those figures of understanding where an economy is moving over the next 3 months, 6 months, and 12 months, that then gives you an understanding of where the currency strength is going. Is it increasing or is it decreasing? What is the best pair to trade that currency against, depending on what their economic health looks like? Once you've broken down that factor, it is only then when you should be focusing on the technical side of your entry. For example, understanding that pound currency has a high interest rate against Japanese yen with a low interest rate. We can see that technically in the markets because pound is strong against the Japanese yen. Therefore, now my technical approach is where is the levels that I want to enter into a buy on the pound against the Japanese yen. And then obviously I'll be monitoring both currencies, fundamentally speaking, their outlooks, because if that changes, then my outlook on an investor sentiment of whether or not I should be buying this currency pair over the short term, mid-term or long term might change. So I want to break down the economic indicators for you. What is CPI, what is PPI, and what is NFP? And how do they affect the market? So CPI, we said, was known as Consumer Price Index. So Consumer Price Index is measuring inflation, and it does this by measuring the price changes within a basket of goods and services. A rising CPI will often increase foreign investment and attractiveness to that currency and increasing that currency's value. So that's CPI increasing, a currency value typically tends to increase as well. Moving on from that, we then have got PPI, which is known as Producer Price Index. This is very similar to CPI, but it's done on a wholesale level. This means that it's good for forecasting and overall can tell us whether or not, consumer price index is looking likely to increase, which means inflation is increasing. This often leads to a currency's value decreasing until they then raise their interest rates, of which we then see a currency appreciating. And then we've got non-farm payrolls. Non-farm payrolls, known as NFP, is a great employment indicator. It measures the employability within the US, excluding the farming sector. An increase in non-farm payroll figures would show that the US is expanding in their labor market. This often leads to an increase in currency value. It doesn't increase necessarily all the time because there might be an outlook that's been seen differently within the political limelight. But as a standard rule of thumb, if we're seeing more employability, economic health is strong, and we can see strength there going into the currency's value. Now let's understand more of a role around the central banks and how they affect the markets and how they participate. So central banks control the interest rates within the market. This will often lead to an increase in foreign investment or a decrease in foreign investment depending on which way they're moving the interest rates. Traders naturally will watch interest rate decisions as it's a good economic indicator to keep your eye on to see whether or not there will be an increase in that investor sentiment or overall the market shifting away from that and it decreasing. So often around these announcements you'll see a large amount of volatility, especially if you're an intraday trader. And obviously from these central banks, they obviously give monetary policy statements which are public to read. This will then give us a forecast or future outlook of what the central bank's sort of plan of attack is to do with those interest rates. And this helps us set up our short-term, medium-term and long-term outlook based on those interest rates decisions, because overall it's going to influence our expectations as traders and overall our interest within that specific currency pair. And then we've got political and geopolitical events. These are big areas, especially elections, with Trump, for example, getting back into power. This can change what the economic outlook looks like, especially changing from Democratic to Republican. How that is seen is very much dependent on the individual. It's not usually based on the parties. Now, the markets don't tend to change in regards to their performance based off of who's in charge. And there's multiple comparison charts out there of how the markets have done with a Democratic president and how they've done with a Republican president. And they vary from president to president. However, monitoring those economic events is super important because again, it gives us an insight in what to expect for the future of that economy. So overall, with the fundamental side of this and looking at these economic indicators, being informed about the fundamentals is very, very important. You can do this by using simple apps like Bloomberg or Finamize, and they break it down in a simplistic way so that you can understand the fundamental side of a currency a lot more with ease. And that's what you want to get started within fundamentals. So implementing fundamentals into your trading strategy, if you can take into account these economic indicators, the geopolitical tensions, the interest rates, the central banks, and the monetary policy statements, it will give you a much better informed decision when you're looking to trade the markets. Looking at the markets from a fundamental approach first, before even looking at a chart, is where you need to start your trading journey. These fundamentals are crucial to understand. Break them down, understand what the fundamental outlook of an economy is over the next month, 3 months, and 6 months. If you can do that and ultimately decide whether that economy is going to strengthen or weaken, will give you a bias of which way you should be buying or selling from a fundamental perspective. Once you've done this, you then want to make sure that your technicals are all in place within the markets so that they align in the direction of your fundamental outlook. By doing this, you take a full 360 approach to the markets and you'll be successful at trading. If you want to find out more about Samuel & Co Trading, then click the link in the description and check out our training that's available on our website. So guys, I hope you've understood the importance here of fundamental analysis and how to implement it. If you know and you're convinced that you know exactly what the fundamental outlook is for pound against the US dollar, get in the comments and tell me where it's going to be within 1 month and 3 months and 6 months from a fundamental perspective. I'm very keen to see your thoughts, especially with it being election year. If you have enjoyed this comment, make sure you thumbs up, comment and subscribe for more content.